how did the US economy become hyperfinancialized? Who benefited, who lost, and what are some solutions? So, first, I want to look at the average American and how they fared. Here I marked China's admission into the World Trade Organization here in yellow. This happened in 2001. And this chart shows the average hourly wage divided by gold. This is one of many charts we'll look at to establish the real purchasing power terms of the average American's wages. And we can see that since China's admission into the World Trade Organization in the early 2000s, which was really when globalism kind of accelerated, this is also when I would argue the hyperfinancialization of the economy really started to accelerate. We can see that the average American, their real wages, the real purchasing power of their wages has fallen consistently and relentlessly. We'll look at a number of charts. Here's another one. This shows personal income over M2 money supply in red. And what we can see is the same exact dynamic that heading in, in the 90s, heading into the early 2000s, the average American's personal income or their average hourly wage, whichever metric you want to use, in this inflation adjusted real purchasing power terms, was rising. And then, as soon as China was admitted into the World Trade Organization, it marked the peak. And ever since then has been declining relentlessly for more than 2 decades. Again, the economy was starting to financialize before the 90s. I would argue around the late 70s to the early 80s was really when this dynamic started to take off. But the real hyper financialization started to occur after China's admission into the World Trade Organization, most favored nation status, all these things that we've spoken about pretty extensively. So here is yet another measure, and this is the personal income per capita, and I want to note that going back to the earliest data that we have here in the mid 60s, this was relatively constant. This was relatively range bound, you could argue. There were periods of time where personal income per capita was outperforming, and the average American was actually getting real purchasing power gains out of their wage. But we can see what happened as soon as China was admitted into the World Trade Organization, as soon as globalism really kind of took off, and the economy started to get so financialized. We can see that the personal income per capita has just been declining relentlessly. Again, in real purchasing power terms, after adjusting for inflation, in real purchasing power terms, the average American has been getting absolutely decimated for the past 2 decades. Here is US wages divided by GDP. This shows the average hourly wage over GDP. And again, with these relative charts, the key, the average hourly wage is in the $30 range. GDP is $26 trillion. So if anyone's confused about the scale here, that's why it shows zeros. It's such an infinitesimal number. But the key here is the relative change. With these relative charts, the actual metric itself, the number itself can be instructive. But in situations where you're taking a number that, 30, 2 digits, and you're dividing it by a, 12-digit number, the scale will just show zeros. But the key is the change, right? Remember, if the numerator is growing faster than the denominator, if the average hourly wage, the rate of change, right? If the rate of change of that numerator is faster than the rate of change of the denominator, this line goes up. Ideally, I would argue that this line should be relatively flat. If you had a balanced economy where kind of everyone is benefiting proportionally, all these lines that we're going to go through would be flat. They would just be a horizontal line. No one is outperforming GDP. No one is underperforming GDP. Well, we can see here that the average hourly wage, the bottom 99% that work for a living, have been underperforming GDP. We've addressed this chart multiple times. Here's US wages divided by M2 money supply. And this shows again a real purchasing power term for the average hourly wage, the bottom 99% that work for a living. And we can see that the average hourly wage has not been growing as fast as M2 money supply. Remember, inflation is a monetary phenomenon, and the money supply is the way to measure inflation, real inflation, because it's the money supply. And the rate of change of that money supply has been faster than the rate of growth of the average hourly wage, meaning that since this line has been declining in the mid 60s, the average American in real purchasing power terms, measuring using average hourly wage and M2, the real purchasing power terms of the average American's wages have been falling. Again, this goes back decades upon decades. Here's one final one that we'll look at. If it'll cooperate, here we go. So this shows the manufacturing employees as a share of the total civilian labor force. And I wanted to show these two lines together, just because of the uh, correlation that you can see between the average hourly wage as a share of GDP and the kind of relative share that manufacturing was playing in the overall economy. Um, and again, we also looked at this line as well, which is U.S. wages divided by M2 money supply. Um, we can see that these all track. And I would argue one of the key issues here for these real purchasing power metrics looking the way they do is the type of jobs that Americans have in the modern economy. You look at services like leisure and hospitality; these are historically very low paying, low skilled jobs. And especially once you couple this with the kind of bipartisan immigration policy, again, from both parties have, generally speaking, agreed that America should admit, millions, tens of millions of low skilled workers from third world, emerging market countries. And the effect that this has is it increases the supply of labor and drives down the wage. Now, this is great for corporate profits. This is great for those that can hoard the productivity gains, which we know are kind of the top 1% and the biggest corporations. But in terms of good, high paying jobs, we can see that manufacturing as a share of total employment tracks almost identically with these kind of real purchasing power metrics that we've been looking at. So we know the average American has not been benefiting, has been underperforming GDP. Who has been outperforming GDP, or what has been outperforming GDP? Here we see total federal debt as a percent of gross domestic product. The other way you can think of this is the total federal debt divided by GDP, with GDP as a denominator. We see corporate profits in red divided by GDP. And then purple, we see the S&P 500 divided by GDP. And again, with these particular the concept here, we're looking at the relative change, at the direction of travel. And we can see that from the mid 60s, we went over this in the first video as well. From the mid 60s through to the kind of early 90s, late 80s, um, government debt to GDP was declining, right? Here in white. Corporate profits in general, this trend was down. If not, you could argue range bound, but once you go back to the early 60s, once you include that, this trend is directionally down. And financial assets like the S&P 500 as a share of GDP, denominated in GDP, all of these were declining, right? So what this indicates is that these particular metrics, government, corporations, and kind of financial assets, and those who hold financial assets, were underperforming GDP. So bureaucrats were underperforming GDP, big corporations were underperforming GDP, and the S&P 500 financial assets and those who hold financial assets were underperforming GDP. Then we see what started to happen. Again, remember that time period of kind of the early 2000s when globalism really kind of took off here. And we can see that all of these lines just headed up and to the right. Remember in white, this is government debt to GDP. So this is, thought of another way, this is the real estate value of Alexandria, Virginia, the real estate market of Washington, D.C. suburbs. In red, corporate profits divided by GDP. So corporate profits relative to GDP. And in purple, S&P 500 or financial assets relative to GDP. And we can see that, .com in 2008 were bad for kind of the financial assets and the financial asset holders. But, we know what they did in response to that. They came in with ZIRP, zero interest rate policy. They came in with QE. They started printing money to buy mortgage-backed securities to kind of prop up the housing market, corporate bonds, which they statutorily were not supposed to be able to do, buying U.S. Treasuries in the off-the-run market, right? All of these things. We know what happened the last time financial markets relative to GDP started to underperform for a prolonged period of time. I would argue the economy had already become so financialized that could not be allowed to continue. And we know what happened. Here's the low in 2008. And we can see for both corporate profits, it's been basically up and to the right. And for financial assets, it's really been up and to the right, which is this purple line here. But the government debt to GDP, I think, is another key piece. A commenter pointed this out in the first video, and it's a great point. I think he thought he was disagreeing with me, but all of his points were excellent, and I do totally agree with them. So I did want to cover that, the kind of government story or the government side of things here. So here in white, we have the fiscal deficit. Remember the fiscal deficit, this is the main, when you hear the deficit, what they're talking about is the fiscal deficit. And that is the difference between government revenue, which comes from tax receipts, and what the government spends in the form of outlays. This is Medicare, Social Security, defense spending, interest. That difference is called the fiscal deficit. And here we see just the nominal fiscal deficit. And in white, we can see that as of the last data print, which was late 2024, fiscal deficit $1.83 trillion. This is an annualized number, so $1.8 trillion per year. And then in green is the trade deficit. And this is, I think, goods and services. Yeah, balance of trade. So this shows the difference between imports and exports. This includes goods and services. There's kind of two main components of trade. There's goods, which is just physical goods, and then there's services, which is, think tech services or financial services, that a bank or a hedge fund might provide, or that a tech company might provide. This particular metric uses, adjust the U.S. economy runs a services surplus, generally speaking, but a major, huge goods deficit. And I think that pointing out the fiscal deficit and its correlation to the trade deficit hopefully illustrates this point, which is, heading into, again, remember that time period that I marked in the first chart of the early 2000s when I would argue things really kind of when things started to really take off in terms of financialization of the economy, and wealth inequality, and kind of it was the peak in the real purchasing power for American wages. Here we see marked September 2000, but it was September 2001. Here we go. So this was when China was admitted into the World Trade Organization, here in yellow. And we can see that, up until that point, the fiscal deficit, we had actually started to run a bit of a surplus here. This was during Bill Clinton in the mid to late 90s. But generally speaking, the fiscal fiscal deficit was not a deficit. It was either balanced or even running in a slight surplus, meaning the government was spending less than it was collecting in revenue. And we can see what's happened since the early 2000s. The fiscal deficit has just exploded. Um, and this ties back into government debt to GDP, right? The way that this has been allowed to happen, if we are not making enough money, right? Think of America like a business. We make stuff, but then we also buy stuff from the rest of the world. Well, if we're only selling, $10 worth of stuff, but we're buying $100 worth of stuff from the rest of the world, our income is only 10 bucks. We're only selling 10 bucks worth of stuff. But yet we're buying 100 worth of stuff. So that delta needs to be covered somehow. You need to come up with that 90 bucks somehow. Well, how do you do that? One of the ways that you can do that, and this is why these are so correlated and so kind of interlinked, is via fiscal and via the fiscal deficit. And we can see that these lines, the trade deficit and the fiscal deficit, both track very closely. Now, here I want to overlay GDP divided by gross federal debt here in this light purple. And then in dark purple is GDP divided by the M2 money supply. And hopefully, you can see that these kind of productivity, this is the productivity of GDP, right? We've been over GDP multiple times, gross domestic product, and what that represents. But I think it's important to note how we get that GDP. Is the GDP that we're getting proportional to, say, the amount of money we're printing with this dark purple line? And same thing goes for debt, right? If we're issuing a bunch of debt, if we're issuing $100 worth of debt in a year, but we're getting $200 worth of return, well, that's actually a great deal. That's actually a productive investment for the country. And so what these two purple lines show is the productivity of our debt and of our money, right? We are printing money via this M2 money supply. I'll make it a slightly different color so it's more easy to see. We are printing money to get GDP, right? When the government prints money and create and expands the money supply, this is counted in GDP. You can argue that it shouldn't be, and I would agree with that, but the reality is for now, it is counted in GDP. And so here are two ways to measure, is GDP outperforming the debt? Is GDP outperforming the money supply, right? We're printing a bunch of money, which equals GDP. Government spending is a major component of GDP, over 25%. But what is the relative change of each? And so here in purple is GDP divided by the gross federal debt. And we can see that since the early 80s, the US has been getting the debt has been growing faster than the GDP, right? That's why this line is going down. Another way to put that is GDP has been growing slower than the federal debt, which is why this purple line is declining. And then in blue and teal here, we see that GDP has been falling relative to the money that we're printing, right? So the money supply is expanding faster than GDP is growing. Put another way, GDP is growing much slower than the rate of the money supply. So regardless of which metric you think is more accurate, especially when you put them together, what we can see is that arguably since sometime in the mid 90s, we have been getting declining returns on each dollar that we print and each dollar of debt that we issue. Now, remember, the debt is mainly that the youth will have to repay. In one way or another, it will be the youth of our country that will have to repay that debt. I argue it'll have to be repaid through a loss of purchasing power, financial repression, is probably the most likely, but there is no free lunch in economics. You cannot defy financial gravity forever, and I think we're getting towards a point of a reckoning. Because here we can see that whether you're looking at GDP relative to the federal debt or GDP relative to the M2 money supply, we have been getting declining and declining and declining GDP. We have been printing our way for prosperity and getting less and less and less actual GDP. The technical way to phrase this is the marginal productivity of each dollar of debt is declining. This is the exact opposite of what you want to see in an economy. So here are three measures of a dollar index. When people talk about the dollar, they can be talking about many, many, many different things. In this particular chart, what we're looking at is the trade weighted dollar. In blue, it's the trade weighted dollar with developed markets. So think Europe, Japan. In purple here, we see the trade weighted dollar with emerging markets. Think Malaysia, Thailand, Vietnam. And then in white is just kind of an overall trade weighted dollar index. What trade weighted means is that, when you're compiling the basket of currencies to compare the dollar to, the value of the dollar to, when you compile that basket of currencies, it should be proportional to the amount of trade that America does with each country, right? So if 5% of our overall trade is done with Vietnam, the Vietnamese currency will make up 5% of the trade weighted dollar emerging market index. And so that is the methodology for these three lines. We can see that regardless of which one you want to kind of evaluate, since the early 2000s, this has been up and to the right. The general trend here of the dollar has been one of strength. We can see, especially recently, there's been kind of a notable divergence here. But in general, the general direction of the dollar has been up. And so I wanted to kind of go over a very simple kind of analogy or way to for everyday people to kind of understand this concept of a strong dollar and what this really means. Imagine you're a European and you make 100,000 euros per year. And say there's an American car company that makes a sports car, say, V8 sports car that you want to buy because you're in Europe and you want a taste of American muscle cars. And that car is 50,000 US dollars. Now let's assume that $1 equal €1. This is called parity. On your salary of 100,000 euros per year, you can buy two of these cars per year. If you wanted to spend all your money on this car, you could buy two per year. But now let's assume that the dollar strengthens versus the euro. And just for easy math, let's say it strengthens $1 is now equal to €2. Put another way, the euro weakened relative to the dollar. Well, now that $50,000 car equals 100,000 euros. And remember, your salary didn't change. You're still making 100,000 euros per year. So now you can only buy one car per year. Hopefully, this example is like simple enough that that this concept, becomes a little bit more clear. Um, Another way to think of it, I guess you could say the kind of the opposite, the inverse of this. You make that $100,000. You're a European. You make 100,000 euros per year, and say you only spend half of it. So you have 50,000 euros left over every single year to save and invest. On average, the S&P 500, kind of broad US stock market goes up about 8% a year, varies, but in general, about 8% a year in dollar terms, right? Because the S&P 500 is a dollar denominated asset. When I talk about dollar denominated, that's, when you look at the S&P 500, the price is in dollars. It's a US dollar denominated asset. And on average, the dollar appreciates about 3% a year versus your local euro, your local currency. Again, this will vary depending on the country that you're in. Here we're using Europe as an example, and I just kind of took a very quick measurement here and found an average of about 3% per year that the dollar appreciates versus other currencies. But depending on the country you're in, this could be 4, 5, 6%. And so you take that, your savings, your 50,000 euros, you sell euros, buy dollars. And say you just did that. Well, here we see that investment would do well, right? Because the dollar, generally speaking, strengthens over time. But you don't want 3 or 4% a year. You want to turbocharge that. You want more than that. So what can you do? Well, you can invest in the S&P 500, in Nvidia, um, you know, US stock market, US real estate, all these things that are dollar denominated that kind of go up and to the right forever and ever. Now you're making money on both directions. If you just holding the dollar, just selling your 50,000 euros and buying dollars, that alone, you would make money, right? We established about 3% a year on average, just very, very general. But you take instead you sell euros, you buy dollars, and instead of just keeping those dollars, now you use those dollars to buy a dollar denominated asset like the S&P 500. Well, now you're making 11% per year. And again, this can be as high as, I mean, recently the stock market, I think in 23 and 24, stock market was up 20% in a year, right? And the dollar had also strengthened, I think, like 5 or 6%. So you're talking about 25% return in a currency unhedged, return for a European. That is an amazing return. And part of this hyperfinancialization, the reason that it is happening is because we have turned the dollar into a funding currency. This is called positive carry here, this particular example where you are making money on both directions. You are making money by selling your local currency, in this example, the euro, and buying dollars. You're making money there, right? Because the euro is falling versus the dollar, or the dollar is rising versus the euro. You're making money on that direction, but you're also making money because in dollar terms, the things that you choose to invest those dollars in, like the S&P 500, maybe real estate, those are also going up and to the right. So you're making money on both directions. This is called positive carry. And a lot of people have heard of the yen carry trade. This has gone on with other currencies too. The Mexican peso has been used as a funding currency for carry trades, but generally the concept is that you're trying to borrow in a currency that will go down, right? Like the euro or the yen, down versus the dollar. You borrow in that currency because 5 years from now, it'll be way easier for you to repay that loan. If you just, invest, take the yen, right? Borrow yen. The yen is falling, falling, falling. Well, you immediately convert those yen into dollars, which are rising. And next thing you know, 5 years from now, 10 years from now, when you go to repay that loan, it's way easier to repay the loan. The value or the amount of the loan just shrank. So this is called positive carry. A lot of people know about the yen carry trade, but not many people talk about the US dollar carry trade. And the dollar carry trade is over $30 trillion. There are tens of trillions of dollars at minimum that are involved in this kind of flywheel effect where foreigners are selling their local currency to buy dollars and then using those dollars to buy US financial assets, dollar denominated financial assets. And again, we know the dollar, on a long-term time frame just goes up and to the right, stronger versus other currencies. So you're making money on that direction as a foreigner, but you're also making money in the S&P 500, the Nasdaq, Nvidia, real estate, single family homes, whatever, farmland. You're making money both directions. And this is because the dollar has been turned into this kind of funding currency where the US's biggest export has become nothing of real value, but the dollar. And so, what would you imagine? Just think for a second. If you have if you have trillions of dollars per year kind of recycled into US dollar denominated assets, what industries would you expect to do well? Clearly, it would be finance, financial services, insurance, real estate, right? The acronym is FIRE, finance and insurance, and real estate, fire industry. And this makes intuitive sense when you have trillions of dollars per year kind of being involved in this carry trade. That money is getting pumped into those industries. And so those industries, the financial industries, do extremely well. This, goes to the concept of Dutch disease. I wrote my first post on this in July of 2024. It's my pinned post on my X profile if you're curious about learning more about this. But this is basically, a phenomenon also known as resource curse, where this what appears to be a boom for your country's economy, in this case, the dollar. The origin of the term comes from the Netherlands when they discovered a huge natural gas field off the coast of the Netherlands, and it's going to be this great thing for the Netherlands. Well, next thing you know, it's hollowed out their industrial base, their agricultural sector. It's basically kind of sucked in all the capital and all the labor and all the resources and all the, kind of regulatory benefits and regulatory capture, all that. Everything just got sucked into the natural gas field, and the currency started to become tied much more to the commodity, the underlying commodity, which was natural gas, right? This was a huge problem for them. And in America's example, this hyperfinancialization has caused Dutch disease in America, but instead of natural gas, we're talking about the dollar. And so, resource curse, Dutch disease. This is a really critical. A lot of people are starting to hear about Triffin's dilemma, which is a very important concept. But Dutch disease or resource curse, this is kind of a parallel, intertwined, related phenomenon that I think is also really important for people to get familiar with, because it explains the hyperfinancialization that we're seeing in today's economy. So, how do we, a number of people were asking in the first, commenting in the first video, well, how do you fix hyperfinancialization? We've kind of established the problem. How do you fix it? And in my opinion, there's kind of two main goals or two main components of addressing this issue. Here, we showed kind of versions of this chart in the first um, in the first video, but it's critical to understand this dynamic. Here in green, we have the balance of trade inverted. This is the trade deficit, right? So as the green line is going up, the trade deficit is getting worse. Remember, the current account is one of the two main accounts of a country's kind of overall financial accounts: current account and then the capital account. The current account is mainly comprised of the balance of trade. There are other smaller components, but in general, the current account is mainly the balance of trade. The difference in the imports versus exports. We're buying $100 worth of stuff, but we're only selling $10 worth of stuff, right? That is the balance of trade, or the trade, or a trade deficit. And in green here, we can see the inverted balance of trade. This line normally, is headed straight down, but here we inverted it, and the reason we inverted it is because this current account deficit, or this trade deficit, can also be thought of as a capital account surplus, right? We were talking about, well, how do you come up with that difference to explain the $90 difference between, well, you're buying $100 worth of stuff, but only selling $10. One of the ways that must get balanced is by capital inflows. So in America, we run a huge trade deficit. And at present, it's about $130 billion per month, 130 billion with a B. And what this can also be thought of is that about $130 billion per month must flow from the rest of the world into our capital account. This is the S&P 500, real estate like farmland, single family homes, corporate bonds, US treasuries, any kind of financial asset. So as the trade deficit gets worse, the amount of capital that is structurally must flow back into financial industries like finance, real estate, financial services, uh, increases. So it's It's the other way of thinking about a trade deficit is that it is a capital account surplus. So when you see the trade deficit, exploding so much higher, this goes back to the early '90s. When you can see how much this trade deficit has accelerated, um, the other way of thinking about this is that our capital account surplus has also accelerated. Um, and so again, this goes to the concept of hyperfinancialization. Well, this is a mechanical structural reason that the brightest minds in America today, they don't go to work to build rockets to put men on the moon or go to Mars. They go to build an algorithm for a high frequency trading firm, Millennium or Jane Street or something, right? Like the MIT grads in the 60s, they were going to NASA, the smartest people in America. Well, now we know what industry has been kind of absorbing all of our talent. And one of the main ones is finance, financial services, real estate, that kind of stuff. And it's just a structural result of a trade deficit that continues to increase without, signs of ever stopping. So that is what we are seeing in green. And then in white, we see the net worth of the top 1% divided by GDP. We can see, again, I mark QE2 and 3. It was a pretty strong divergence, but in general, these lines track each other. As the balance of trade gets worse, as our trade deficit gets worse, the net worth of the top 1% relative to GDP increases faster and faster. So the rich are getting richer. The worse the trade deficit is, the worse the balance of trade, the richer the top 1% get, and the quicker that the wealthy get wealthier. And so we'll go through a couple of them real quick. Here is the median sales price of a single family home divided by the median family income. Again, QE 2 and 3, we see this divergence with both the net worth of the top 1% and the single family home market. Both of them kind of diverge from the trade deficit, the balance of trade. And then single family homes at least start to correct and when quantitative tightening started to reverse some of this QE. But like in general, these lines are relatively tracking. And here's the S&P 500 relative to GDP. And we can see again, these lines are very similar. As the balance of trade gets worse, the S&P 500 does better. And here's corporate profits in yellow. And again, the balance of trade in green. And we can see that, again, as the balance of trade gets worse, as the trade deficit gets worse, corporate profits increase faster and faster and faster. So balancing this structural element is critical. Any politician, and for me, my opinion, any politician that is working to balance trade will get my support. I don't care what party they're from. This is one of the key reasons that we have wealth inequality at levels not seen since the Gilded Age. All the second and third order effects I've repeated so many times in American society now. This is the reason that we have such a hyper financialized economy. This is a structural reason for this, kind of broken economy. So anyone that is willing to take on the trade deficit and try to balance trade, try to reduce the trade deficit. This has been decades in the making. This is not going to be reversed overnight. Be very skeptical of anyone that says that this can be reversed in anything short of a decade. But removing this mechanical structural side is critical to making the American economy something that works for everyone. And the other key kind of solution here is the dollar, right? We were going over the dollar and kind of the way that this positive carry trade has been set up, where the dollar just goes up and to the right. You're a foreigner. You sell your local currency and you buy dollars and you just make money forever and ever. Well, the other consequence that this has is that this, if you're an American company, if you make that sports car in the first example that we went over, as the dollar gets stronger, foreigners can buy less of your stuff. So here, we'll put this one back on. Remember, when the dollar strengthened in this very, very simple example, when the dollar strengthened, the purchasing power of the foreigners didn't change. But now they could only buy one half as many cars as they were able to when the dollar and euro were at parity. Remember? So this is the other side of an ever strengthening dollar, is that it makes, US goods more expensive on a relative basis, more expensive for the rest of the world. The rest of the world can buy less stuff made in America. And so we get, the manufacturing employees as a share of the total civilian labor force doing this. And consequently, because those are, kind of high paying jobs, we get the average hourly wage, the real purchasing power terms of the average hourly wage, we get that declining relentlessly, basically in line with that kind of decline in manufacturing and in high paying manufacturing jobs. Um, and so this other side of the dollar, it is great for finance, but it is really bad for real things, real stuff, real productive American economy. It is horrible, and it hollows out that real net productive economy, and we get situations like this where the GDP that we're getting is sure in nominal terms, GDP is going up exponentially, and it looks great. But once you start to adjust for the amount of debt that we're putting our youth into, the amount of debt that we're issuing to get that GDP, or the amount of money that we're printing to get that GDP, we can see that the actual real return, America is not net productive. On a very, very simple, in very simple terms, the American economy is not productive. On a net basis, we run a twin deficit. We run a trade deficit and we run a fiscal deficit, which means that on a net basis, the American economy doesn't really, it's not really net productive. That is not sustainable, clearly. And once you start to adjust the GDP that we're getting, which is kind of the overall economic output, once you start to adjust that for the federal debt or the amount of the money supply, the money we're printing to get this kind of fake GDP, the picture gets even worse. So we're already a twin deficit nation. So we're already not net productive, kind of on a definitional level. But then you start to look at the productivity of them, the money supply, the money we're printing, or the federal debt, and the picture and the situation gets even worse. This is what happens when the dollar gets so strong and so overvalued. It's important to note that not only a weaker dollar is certainly part of the solution here, but just a fairly valued dollar. The dollar has become so overvalued, right? We established that we are running a huge fiscal deficit and a huge trade deficit. Um, what this means, in kind of fair fundamental valuation metrics, this, the currency of this country that is running these huge twin deficits should be weakening. But what do we know? Well, the currency's been strengthening. This is completely disconnected from any, kind of reality. This is the opposite of how it should be. In a country that is running a huge twin deficit like this, the dollar should have been weakening, but, relatively in line to adjust for the fiscal reality, for the fact that, the country is not net productive. I mean, just think about it very simply. If you are a person that spends 100 grand a year, but you only make 50 grand a year, well, you're not in very strong economic health. It's really no different than a twin deficit country. Of course, there are, all sorts of kind of idiosyncratic things and people will quabble with that. But in general, just as a very basic way of thinking about this, the currency of a country that is not net productive, where they are running a fiscal deficit and a trade deficit, that currency should not be getting stronger. It it should be getting weaker. But we know that the currency has been getting stronger. And the reason for this is that kind of inelastic, persistent, price insensitive demand due to the reserve currency status. a lot of kind of normal people, everyday people, lay people talk about that reserve currency status as if it's a good thing. But it is, in fact, the very thing that is causing hyperfinancialization, wealth inequality to soar, right? All the issues, declining real purchasing power, wages, all these things. The dollar's overvaluation is a huge driver. We established that solution one is to balance trade or to reduce this trade deficit, to start to address the trade deficit and bring it down. That's part one. Part two is to weaken the dollar. And I'm not talking about, the dollar being weaker than its fair value. I'm just talking about fair value, just on a fundamental basis, on a balance of payments basis, on an interest rate differential basis, which is how currencies have historically been valued. The dollar is at minimum 50% overvalued. So you need a weaker dollar. When you have a weaker dollar, all of and we're starting to see the first signs of this in the past month or two. We've been doing videos on it, but you're starting to see this particular administration, either intentionally or unintentionally. I think it's intentional, but you're starting to see them address this particular issue. And in fact, the chairman of the Council of Economic Advisors, Stephen Myron, has talked about that. I've followed him for a long time, for many, many years. He's talked about this for a long time now, and he wrote an entire paper called A User's Guide to Restructuring Global Trade, where he argued for just this. I mean, you read that article and then you rewatch this video, you would think we're the same person. I mean, the things that he said are all the things we just spoke about. And he's the chairman of the Council of Economic Advisors of the United States of America. And he understands this dynamic. He understands Dutch disease and resource curse, how the biggest export of America has become the dollar, how it has led to this hyperfinancialization. J.D. Vance also understands this. He pressed Jerome Powell about the downsides of the dollar's overvaluation and reserve status. You have Besant, who has spoken about this concept as well. All very important people, and they all clearly understand the dollar is way overvalued on a fair value, fundamental purchasing power parity basis, on a balance of payments basis. The dollar is way overvalued, and it is hollowing out our real productive economy. It is causing, soaring wealth inequality, declining real purchasing power of, the average American's wages. All of these effects go back to the dollar and the structure of the system. The hyperfinancialization is just kind of a consequence of this, dollar system and this kind of overvaluation of the dollar. Um, but it's really not like the root cause. The root cause is the dollar. The only reason that hedge funds and financial services and real estate and in the investment industry and all this kind of stuff, financial services, the only reason these industries have gotten so big and kind of absorbed so much wealth and talent is because of the structure of the system. Because the dollar is so overvalued, we've turned it into a funding currency where foreigners are basically incentivized to just sell whatever local currency they can get, sell it, buy dollars, take those dollars, invest it with some American investment bank or hedge fund or whatever, right? And it's not that hyperfinancialization is the root cause. It is just kind of a consequence of this bigger problem, which is the structural trade deficit. Number one, this is what we've been talking about here with the capital account surplus, and this dollar system, this kind of post Bretton Woods dollar system, where the dollar is just perpetually overvalued, the real economy gets hollowed out, Triffin's dilemma, all this kind of stuff. So the two key, just to summarize, in my opinion, the two key solutions here is a fairly valued dollar, which again, on a balance of payments basis, on an interest rate differential basis, is going to be much weaker. This will incentivize American stuff to be sold to the rest of the world. This will reduce the trade deficit and make American goods more competitive. A weaker dollar also, for the average American, the average American probably hears a weaker dollar and they think this is a bad thing. And sure, imports, right? All that cheap stuff that you go on Alibaba for, yeah, that will go up in price with a weaker dollar. But you know what goes up? Your wages, right? Because with a weaker dollar, that there is another side of the coin. Sure, imports get more expensive, but the other side of the coin that the mainstream kind of media never seems to mention is that now manufacturing is suddenly cost effective, competitive. And so what do you know? High paying manufacturing jobs start to come back and the real purchasing power, terms of the average American's wages go up. So yeah, sure, cheap plastic stuff on Alibaba gets more expensive, but you're making more money in real inflation adjusted terms because high paying manufacturing jobs are coming back because suddenly it makes sense for American stuff to be made in America and sold to the rest of the world because we have a fairly valued currency. When you have an overvalued currency, it doesn't really make sense to make stuff in America because you can't really sell it to the rest of the world because all these other, kind of weaker currency countries, their stuff is so much cheaper than that American thing, which is so overvalued due to the strength of the dollar. So the two key kind of solutions here are a weaker dollar and not too weak, right? We don't want the dollar to be undervalued. We just want it to be fairly valued, which on the DXY is probably at least 50% from here. Much smarter people than me have written papers about this that I've read, and the estimates vary between like 40 and 70% overvalued from those kind of academics, but significantly weaker from where it is here. And now all of a sudden, high-paying manufacturing jobs come back to America. The average American, the real purchasing power of their wages actually starts to go up for the first time in a while, and they benefit from a weaker dollar. Who doesn't benefit from a weaker dollar? The finance industry, right? This has happened before in the 60s. This is the personal income over M2. Yeah, personal income over M2. And we can see that this did happen, right? We've talked about this populist era of the 60s into the 70s. But we can see that, the average American, the real purchasing power terms of their wage actually went up. So it is possible. Now, who benefit, if the average American is benefiting from a weaker dollar, the people that will lose are financial asset holders, the government, and anyone in the kind of financialized industries like finance, financial services, real estate, investment, all that kind of stuff. And we know the vast majority of the wealth is held by those particular people, those particular industries. So the opposition to this will be immense. But it is important to understand why, right? When you turn your TV on at night and and you hear some of the hyperventilation about some of these things, it's important to understand why certain people are hyperventilating about it. And hopefully this video did, start to get into kind of some solutions and maybe a deeper level to this concept of hyperfinancialization. I did, there's still a number of things that I had to leave out just for time. This is a very complicated subject, very complex, and you can go for hours and hours and hours, but trying to keep these short. So hopefully that was educational, instructive, informative, interesting. Please leave a comment if I missed anything or if you found it helpful. And yeah, maybe part 3 is coming next.